Hello, welcome to Joe's Finance Fundamentals. Today, How to Invest, Part 3. I'm going to be talking about specific investments that you can use based on your objective and your time horizon. But first, a disclaimer that this information is intended only to provide general financial education for informational purposes only. The information and opinions within should not be regarded as objective facts. This content does not provide financial, tax, legal, or any professional advice. Personal financial decisions should not be implemented based on the content of this channel. Do not act upon any information without first consulting a licensed investment, tax, or legal professional. Okay, in the last video, How to Invest Part 2, I started to talk in more detail about mutual funds, and I introduced the idea and the difference between an actively managed mutual fund and a passive or index mutual fund. I wanted to continue with that for just a minute here and say that passive mutual funds have overtaken actively managed mutual funds in the last, say, 10 years. And that may be due to the Warren Buffett effect. You may not be aware what I'm talking about there. And basically, Warren Buffett, you probably heard of him, probably the most famous investor in the world. Several years back, maybe 15 now, he issued a bet with a bunch of hedge fund managers that over a 10-year period, the S&P 500 would outperform their hedge funds. I think the bet was for $1 million. Well, it wasn't even close. I think after 5 or 6 years, or maybe 7 years, the hedge fund guys, conceded defeat. And I think Warren even offered to kind of do a double or nothing for the following 10 years, but they weren't interested in that. And that got a lot of publicity, and rightly so. And that's really helped, I think, spur what was already the trend, but has kind of speeded it up. Now, I haven't talked at all yet about taxes and investing, and that's very important and something you're going to want to do research on yourself. So, especially with mutual funds, it's something I've gotten burned on one time. I didn't really understand this, so I want to share it with you. So, it's important to understand the tax implications of mutual funds, especially for active funds. You probably will owe capital gains taxes even if you didn't have any activity. If you've bought shares of that mutual fund in 1 year and you have not sold it during that year and even the following year, let's say, you still could have taxes and probably will have capital gains taxes. That's different than if you bought stock in an individual company. So if you buy stock in that company and you don't sell it, you only pay a capital gains, assuming it has gained. You would only pay that when you sold the stock, which could be years later. For an active mutual fund, actively managed mutual fund, you have to pay the capital gains tax every year. And the reason for that is, even though you may not have sold shares in that fund, the fund itself is buying and selling throughout the year. So at the end of the year, that all gets netted out against each other. And if they've had a gain, and any stocks that they've sold have had a gain, and that offsets any losses, then that gain will be passed on to any of the shareholders of the fund. I didn't know that a few years ago, and kind of, like I said, kind of got burned with a large capital gains tax. Now, since index funds don't trade stocks in their portfolio nearly as much, really pretty much they don't do it at all, they are a great choice for taxable accounts. And if you want to own active funds, it's probably best to put those into retirement accounts. So I just wanted to pass that information along. And speaking of mutual funds and index funds in particular, these are the top 10 largest mutual funds as of October 2023 per U.S. News and World Report. You can see there's two Vanguard funds that I talked about in the How to Invest Part 2 video, the Total Stock Market Index, the Vanguard 500 Index Fund. Those are the two largest mutual funds. And you can see the expense ratios. So I wanted to also kind of hammer home the point of index funds, and the third one is the Fidelity 500 Index, which even has a lower expense ratio. A couple of these are money market funds. But the last two here, interestingly enough, are actively managed funds, I'm pretty sure. I don't know much about them, these American funds. I'm pretty sure they're actively managed. Look at the expense ratios. So way higher expense ratios, which makes sense because they're employing people to manage pick these stocks and manage them and figure out when to buy and sell and all that stuff. And that those folks cost a lot of money. So that's one of the reasons why it's very difficult for actively managed funds to beat the performance of index funds. One of the big reasons is because of the cost disadvantage the active funds have. They cost a lot more to run, and those expenses come out of the overall performance of the fund. Okay, so I'm going to move on now and show you, more or less a sample portfolio. These are funds that I've used throughout my investing life. And please remember, this is intended only for general financial education, for informational purposes only. And the information and opinions within should not be regarded as objective facts, and you should do your own research, and if needed, talk to financial professionals before taking any action. There's a lot of information here, but it's really pretty easy to understand, I hope. Along the left side here in these first two columns, the first column is the objective. So, what are you trying to accomplish with your investment? Are you building an emergency fund? Are you saving for a large purchase? Are you saving for retirement? Are you saving for college? Are you in retirement? Or the last one here I have is if you have a health savings account, which I talked about in How to Invest, I believe, Part 1. If you have a health savings account, that's your objective. So within each of those objectives, the columns here across the top would be the time horizon. So how long do you need? How long will it be until you need that money? Is it 1 to 3 years? Well, if so, I would suggest investing in a money market mutual fund where there's really little risk and pretty good reward right now, actually, with 5% interest. And on the Vanguard risk reward scale that we talked about in How to Invest Part 2, that's like a 1 or a 2. So again, if you need that money for a house down payment, for example, in 1 to 3 years, I would not advise putting it and rolling the dice in the stock market. Mutual fund is a safe investment. A bank certificate of deposit would also be something along those lines. Now, if you're in a 3 to 10 year horizon, it's kind of more the moderate risk reward, right? 3 on the Vanguard scale. A little bit more toward the moderate risk. If you're 3 years, you're going to need it versus 10 years. You can be a little bit more aggressive. Now, a lot of these funds here that I mentioned, like the Balanced Mutual Fund or the S&P 500 fund, I'm mentioning those, showing those in various, if you have a saving for a large purchase, saving for retirement, saving for college, they're applicable to all those longer term or medium to longer term objectives. And if you move to the right here in greater than 10 years, now you're out, furthest on the Vanguard scale, high risk, high reward. Here's where you want to take a little bit more of a chance to grow. And if you have a few years where it doesn't do well and you lose money, you're not needing that money. And generally speaking, over the long term, the stock market has done very well. So this is, again, a more aggressive risk reward. But I'm using a lot of the same funds. For retirement, you might want to use one of those target date funds I talked about. You also may want to get into more of the this is where I would get in if you want to, more of the active mutual funds and or individual stocks. So in summary, for a lot of these categories, for a lot of these objectives, for a given time horizon, we're talking about the same types of funds. So you don't need 20 different mutual funds. You really need your money market mutual fund, what I'd call a balanced mutual fund, and then maybe a more aggressive one like a stock, the total stock market index fund, an S&P 500 fund, or active funds and stocks for longer term time horizon. I also mentioned here, and really haven't talked about it on the greater than 10-year side, some international mutual funds. So these mutual fund companies like Vanguard also offer international mutual funds. And for many years, they were, it's very good to diversify away from, say, US only. They were a good diversifier. It hasn't been really that way in the last 10 years or so. They haven't really done that well. They tend to follow the US market, meaning if the US stocks go up, international goes up, vice versa. US stocks go down, international go down. I still own an international index mutual fund in one of my retirement accounts. I think, for the long term, it's probably good to have those. I think over time it will do a little bit better than it has done, and that's why I have it. So there it is, kind of laid out. And again, please make your own decisions, but just trying to show you some of the options you may have for your different objectives and your different time horizons. Okay, have a great day. Thanks for watching, and talk to you again soon. Bye-bye.